Most people think their money is safe in the bank, but that's not even close to the whole truth. Right now, fundamental changes to banking rules are unfolding, and they could impact your financial future in ways you never expected. While you might feel secure with your savings, the reality is that these new regulations are stirring anxiety among the wealthy and informed. In this video, I'll break down the critical rules you need to pay attention to and how you can proactively safeguard your assets. Don't let the shifts in the banking landscape catch you off guard. I'm Aria Vale, and this is The Wealth Shift. Recent changes in banking regulations are reshaping how we understand financial security. Many individuals are under the impression that their deposits are safe, primarily due to the historical precedent of government bailouts. However, this comfort is being challenged by a new reality: the shift from bailouts to bail-ins. When a bank faces insolvency, it is no longer solely the government's responsibility to step in. Instead, the burden can be placed on shareholders, creditors, and even large depositors. This transformation in policy raises a critical question about the safety of funds held in banks. Take, for example, the case of a mid-sized bank facing significant losses. In the past, the government might have intervened with taxpayer money to stabilize the institution. Today, under the bail-in rule, if the bank cannot recover, funds within it could be used to cover losses. This means that if you hold more than $250,000 in the US or exceeds the insured limits in various countries, you could find yourself at risk. The psychological safety net that many people relied upon is gradually fraying, exposing the vulnerability of their financial assets. The implications of this shift extend beyond individual bank accounts. As these changes percolate through the financial system, a pervasive sense of uncertainty begins to influence broader monetary behavior. Wealthy individuals are especially concerned, as they often hold amounts that exceed insured limits. Their anxiety feeds into market volatility, as they may be less inclined to invest or spend, leading to a reduction in economic activity. This ripple effect can slow down growth and impact everything from hiring practices in businesses to consumer confidence. Moreover, the psychology behind financial behavior becomes a crucial factor here. People often tend to underestimate risks when they perceive their environment as stable. The assumption that government intervention is a foolproof safety net can lead to complacency. However, the new rules disrupt this narrative, fostering a sense of urgency. Individuals may begin to question their financial strategies, prompting an emotional response that could manifest in panic-driven decisions. When fear dictates financial behavior, it can exacerbate market instability, creating a vicious cycle of uncertainty. Additionally, many people make invisible errors in judgment regarding their financial safety. They may wrongly assume that simply diversifying their assets is enough to safeguard against potential losses. However, if a large portion of their wealth is tied up in a single financial institution, this strategy may not be as effective as they believe. The reality is that real diversification requires a more nuanced understanding of risk exposure, particularly in the context of changing banking regulations. The impact on financial decision-making is profound. These days, individuals must evaluate more than just the performance of their investments. They must consider the financial institutions holding their assets and the regulatory framework surrounding them. Decisions around savings, investments, and spending will inevitably be influenced by these factors. Individuals may feel compelled to shift their funds to perceived safer havens, even if these alternatives yield lower returns. In this evolving landscape, the control individuals once felt over their financial futures is fading. Instead of viewing their money as a tool for security, many are beginning to see it as a potential liability. This shift in perspective forces a reconsideration of wealth accumulation strategies and risk management practices. For those who are already financially savvy, it calls for an even more strategic approach to safeguarding their assets. The stakes have risen, and the need for vigilance in protecting wealth has never been clearer. As the financial terrain becomes increasingly complex, individuals will need to adapt their strategies to navigate this new reality effectively. Understanding the implications of banking reforms is crucial not just for personal finance, but for the broader economy. The challenge ahead lies not only in protecting wealth, but also in regaining a sense of agency in a system that feels increasingly unpredictable. The changes are here to stay, and it's imperative to engage with them rather than ignore the underlying risks. The psychology behind financial decisions is a complex interplay of emotions, biases, and societal influences. Many people fall prey to cognitive biases, like loss aversion, which can skew their judgment. For example, the fear of losing money often outweighs the potential for gains, leading individuals to avoid strategic investments. This mindset creates a cycle of missed opportunities. When faced with uncertainty, individuals tend to stick to the familiar, often overlooking more lucrative options simply because they seem risky. Consider the individual who hesitates to invest during a market downturn. The instinctive response is to pull back, driven by fear of loss, rather than to assess the potential for future growth. This choice is not just a simple reaction, it's a manifestation of how our brains interpret risk. The mental shortcuts we rely on can distort our financial decision-making, often with severe consequences. Invisible errors in judgment compound these biases. For instance, overconfidence can lead investors to dismiss valuable information. They may think they understand the market better than they actually do, which can result in poor investment choices. This tendency is amplified in times of volatility, where emotions rather than data dictate behavior. When emotions take the wheel, rational decision-making takes a back seat. It's crucial to recognize these pitfalls. Awareness is the first step toward mitigating their impact. When individuals confront their biases head-on, they can begin to recalibrate their approaches to investing. This shift in mindset is not easy, but it's necessary for anyone serious about safeguarding their financial future. In this landscape, the power of peer influence cannot be overlooked. Social pressures can lead individuals to make decisions aligned with the group rather than their financial best interests. For example, if friends are investing heavily in a trending stock, one might feel compelled to follow suit, ignoring their financial strategy or risk tolerance. This herd mentality can distort personal judgment. Surrounding oneself with financially savvy individuals can provide a counterbalance to these pressures, encouraging more informed choices. Now, let's explore the impact of these psychological factors on financial decisions. People may also underestimate the time and effort needed for proper research, believing they can make quick decisions without thorough analysis. This false sense of ease can lead to investments that don't align with their long-term goals. The allure of immediate rewards can overshadow the need for disciplined planning. Imagine a scenario where someone invests in a hot startup based solely on hype rather than fundamentals. As excitement swells, due diligence often diminishes. When the inevitable reality hits, the fallout can be devastating, not just financially but emotionally as well. The combination of fear and regret can lead to a withdrawal from investment opportunities altogether, further entrenching a cycle of inaction. Understanding these dynamics is essential for taking back control over your financial journey. Recognize the influences at play and make a conscious effort to engage with your financial decisions holistically. This proactive approach is crucial for reclaiming a sense of agency in an unpredictable system. As the landscape shifts, individuals must adapt to maintain their financial health. Awareness of biases and social influences can foster resilience. This enables better decision-making grounded in data rather than fleeting emotions. If you haven't already, consider reflecting on your own financial behaviors. Are you making decisions based on fear, or are you choosing to act with confidence backed by knowledge? By embracing a more mindful approach to your finances, you can navigate this unpredictable landscape with clarity. The changes ahead are not just challenges, they represent opportunities for growth and redefinition. Pay attention to your instincts, but don't let them dictate your choices. The real power lies in informed decision-making, grounded in a clear understanding of your financial goals and the broader market dynamics at play. Ultimately, Each step taken toward financial literacy strengthens your position against the unseen traps in the market. Investing in yourself through education and awareness can yield returns far greater than any stock ever could. Embrace the journey ahead with an open mind and a clear strategy. Your financial future deserves it. Navigating the complexities of finance demands more than just a basic understanding of numbers. It requires a keen awareness of the subtle influences that shape our decisions. As we explore the impact of these influences, it's clear that they can lead to both opportunities and pitfalls, shaping not only our portfolios, but our overall financial health. Consider the common scenario of individuals adhering strictly to tax regulations. They're diligent, filing accurately and on time, yet they remain anxious about the potential for aggressive tax authority actions. This fear often leads to hesitance in pursuing international opportunities or diversifying assets. The visible problem isn't just about compliance, it resides in the invisible barriers that restrict financial growth. The effects of this apprehension are profound. Fear can paralyze potential investors, causing them to miss out on lucrative opportunities. When opportunities go unseized, a chain reaction is set in motion. Less investment means fewer growth avenues, and a stagnant financial portfolio becomes the norm. The irony is that the very desire for security inadvertently curtails the potential for prosperity. Psychologically, this is tied to a deeper sense of control. When individuals feel their financial choices are limited by external pressures, they often retreat into the safety of conservative investments. This mindset cultivates frustration and disillusionment. The fear of the unknown drives many to hold their assets in accounts that may not yield favorable returns, trapping them in a cycle of mediocrity. Invisible errors compound these challenges. Many fail to grasp how risk and reward interplay in ways that don't always align with conventional wisdom. They may not realize that maintaining cash reserves during periods of low interest can erode purchasing power over time. A misplaced focus on safety at the expense of growth leads them to miss out on compound interest, one of the most powerful forces in finance. The impact on financial decisions is substantial. Those haunted by the fear of aggressive tax scrutiny often avoid investments in foreign markets, missing out on diversification and potential gains. This avoidance is not merely a choice, but often a subconscious response rooted in past experiences and societal narratives. Over time, these fears can become self-fulfilling prophecies, cementing a mindset that overlooks opportunities for wealth accumulation. Now, let's pivot to the tangible changes in everyday life resulting from these dynamics. Individuals who remain mired in fear and hesitation may find their financial goals slipping further from reach. Retirement plans become less secure, and the dreams of financial independence fade. Conversely, those who confront these fears head-on and embrace calculated risks tend to experience a shift in their financial landscape. This transition doesn't happen overnight, but it can lead to profound changes in life quality and freedom. Investing in education and understanding the behavioral patterns governing financial decisions can be transformative. It empowers individuals to navigate complexities with confidence, turning perceived threats into manageable challenges. As they begin to see opportunities where they once felt confined, the ripple effect in their financial journey becomes evident. Ultimately, the financial landscape is not merely about numbers, but about the decisions driven by our perceptions and fears. By recognizing and addressing these underlying patterns, individuals can transform their relationship with money. The clarity gained from understanding these dynamics offers a new lens through which to view financial decisions, shifting the narrative from one of fear to one of empowerment. This journey is not just about avoiding pitfalls, but actively seeking pathways to success. The challenge lies in shaking off the fears that hold you back and stepping into a more informed and empowered version of yourself. As you navigate your financial future, remember that knowledge is your greatest asset in this ongoing wealth shift. This is Aria Vale, and this is the Wealth Shift.